Hi, Byron Moore and Mike Jones with Argent Advisors here. We've been coming to you on these regular update videos for 5 or 6 months now, since about
five-ish
March.
months.
Yeah, something like that. And I don't know about you, Mike, but I'm kind of getting too used to wearing a face mask. I'm trying to be a good boy and wearing a face mask, but I'm getting used to it. But I don't like it, okay? But I'm doing so. Well, one of the things that we have learned is that no news is never good news. And so we always want to come to you and give you a regular update on what we're seeing and what we think that we see coming down the road. By the way, you know we haven't been able to invite you into our offices, nor have you really probably wanted to get out all that much. We have been doing some of our meetings virtually, and we're certainly able to do that. But a video like this on a regular basis is one way we can talk to all of you, and it's a vehicle that we want to keep on using. Mm-hmm. So Mike, over the last few weeks, the government has come out with some information on recent economic performance. Can you talk to us a little bit about what those figures have said?
We do get a report every quarter as to how our economy is doing overall. And so the sum total of everything, all the goods and services out there, is known as the gross domestic product. And so we've got a chart today that goes back into the 1940s that shows every quarter what the gross domestic product has done. And what you'll notice is that in the last quarter, the numbers we just got, it was down 9.5%. And that's a raw number, so almost 40% on an annualized basis, but 9.5% for the quarter. And you can tell by looking at this chart how this compares to all these other quarters going back. We've not seen anything like this.
So Mike, if we have an economy that does roughly $20 trillion a year in GDP, and it went down, can we just round up and say almost 10%?
Right.
So you're saying in a quarter we're down $2 trillion.
$2 trillion worth of goods and services. And you know, when you stop and think about it, because of the lockdown, it could have been worse.
Yeah.
But that is a devastating blow to our economic system.
We saw the Fed react in a very different way than it did almost 100 years ago when we had a Great Depression. Just give us a reminder of what the Fed did in the late 20s and early 30s when the Great Depression, and then how they almost did the exact opposite in 2008 in the financial crisis, and much more so even recently.
Yeah, we did learn a lot, both from the studies of the Great Depression, when the Federal Reserve thought that we've got to rein in everything. It's getting out of control. And they created so much scarcity in the system that it plunged us into a Great Depression. Okay. So this time, what they said was, whatever slack there is in the economy, we're going to try to make that up with fiscal stimulus. We're going to put money into the system to make up the slack of the slowdown. So the next slide that we want you to see today is what our government has done, and relative to Europe and to Japan, other big economies, because there's been fiscal stimulus of about 10%. So we don't know what's going to happen over the next few months, but I think our Fed has done a masterful job to date of, at least over the short term, injecting enough into the system to pick up the slack as to what's going on.
So if you missed the math on that, the GDP had a decline of about $2 trillion.
Right. And
so the government injected about
$2 trillion.
$2 trillion. So we'll see what happens, but they tried to replace what was taken away. Great. We've got another chart to look at that shows what, Mike? Something about the money supply.
Yeah. So to not get too professorial here, but the money supply as measured by M1 has gone up dramatically. In fact, what this shows is it's up 35% from where it was. So it just means that money has been infused into the system. Okay. So the amount of cash, the liquidity that's out there in terms of real money in the system, the government has made that go up to take the place for a lack of productivity.
Okay, great. And then just one more chart that gives another perspective on money supply.
Yep, and that's cash on the sidelines.
Okay.
And so all of the money that has gone into, so kind of the, Byron, the feeder system for people buying stocks and bonds and mutual funds and that type of thing really is the money market system of the United States.
Yep.
And so if there is a lot of money in the money market system, that means there's fuel to go into investments. And so that's why I wanted to bring this chart in to show why the markets have done what they've done, at least of late, because there's a lot of money to go into the market.
So there's money in the market already, and yet there may still be more yet to come.
Correct.
Okay. Mike, it's easy for the average investor to think of the market as just this big monolith. We've got hundreds and hundreds of companies that all more or less do the same thing, but of course, that's not the case. This year, we've actually had a few companies that have made a much bigger splash than normal. Can you tell us a little bit about those, what they've done, and kind of how they've maybe even distorted a little bit the returns for the rest of the market? Can you tell us a little bit more about that?
Yeah, there's a phenomenon going on right now that, one, I didn't see coming, but two, has been most amazing. And we know that in the world that we live today, that companies that can continue to grow and grow fast, even in the midst of the pandemic, that we want to be invested in those. And so companies like Microsoft and Facebook and Google and Amazon, there are 5 big companies that have just gone up and up and up. And what this chart shows is 3 years ago, those 5 in the S&P 500 were worth about $2.5 trillion. Their market capitalization, their value in the market right now is over $6.5 trillion.
That's amazing.
And when you look at the chart and you see where they were in March and what they've done from March to now, it's just been an explosion to the upside, which has helped the averages, but it doesn't mean that every stock has made that type of return. Of course, they have not.
Mike, a number of our clients, you for them, use dividend-paying stocks as one of the tools to provide income for clients that need a current income. And we know that one of the things that we've seen of late is that the performance, the total return of those of the dividend-paying stocks has been lagging behind some of the other more growthy kind of stocks. Can you talk about that a little bit and what investors should sort of expect from that?
Yeah, and this is really one of the main things that I wanted to share with our clientele, and we've got different people with different goals and different objectives. But if you're of that type where you've got money invested because you need us to send you a check every month, and we've got dividend paying stocks and we've got bonds to create that cash flow so we can send you that check, then for reasons of which we don't want to go into all of those today, but they doesn't represent those high-flying growth stocks we just mentioned, that those stocks on average are down about 15% for the year, and so they have lagged. Needless to say, because you're looking for those dividends, that index does not have the Microsofts and the Facebooks and the Amazons and the Googles in it.
Okay.
And so you don't get the bump from their performance, but that's only year to date.
Right.
That's not historically what has occurred.
So let's bring up another chart that we can look at that gives us a little better historical picture of what dividend paying stocks, specifically stocks of companies that have paid a dividend that goes up a little bit every year, or so-called rising dividends, how those have done historically versus all the rest of the kind of stocks in the market.
Yeah, it's a great reminder to go back and look in time to see that if you own a basket of stocks that are paying handsome dividends, but they also aren't paying all of their earnings out, and they can raise, even if it's just a little bit every year, that over the long term, those have actually been some of the best performing baskets of stocks a person could own.
And that's that line that's the uppermost. That's the winner in that chart that we're looking at. Those are the rising dividends. And you may not be able to read those numbers, but those numbers do go all the way back, really a full generation back to the early 70s.
Yes, they do.
Yeah, yeah. So Mike, connect the dots for us a little bit between some of the information that we've just looked at and what's going on in the market, and then I'll close with one last question.
Okay. So because of the fiscal response and the stimulus, what our Treasury and what our Federal Reserve System has done, the markets have gotten back on good footing again. We don't know what tomorrow will bring, but it has allowed a buoyancy that honestly many of us didn't think would be there back in February, March, and April. And so, I would like to take the moment and enjoy as much of this as we can.
Yeah, yeah. Talk a little bit then finally about risks that are out there. There's always risks, and that's really maybe the number one thing you're on the lookout for when you wake up every day. What are the risks that you see out there? And although there's no perfect safeguard against every risk, what are the things that you're doing right now to guard against some of those?
Yeah, so I think the Fed has made the right moves to date, but you don't create that much more money into a system like we have and not run the risk of inflation down the road. And so I think that we're going to have to keep our eyes out for inflation. It might not come across the board, but there will be pockets that, and those pockets will have impact on certain type of investments. And so that's one of the things that we're going to have to certainly be careful of.
Okay. So, as we close our session today, one of the tools that we've been using of late is a risk assessment tool. We mentioned it last time, and I've seen Mike use this tool with clients with great effect. It's called Riskalyze, and it's something that over the next couple of years we hope that we'll be able to introduce to everybody in our client base. If you would like to get your risk number, it's almost like a speed limit number that shows really sort of the meeting place where the portfolio that you've got and really what's going on inside your heart and mind, that risk number. If you'd like to see that for yourself, give us a call. Call us or email us, and we'll set up a time that we can get with you, give you a brief questionnaire that will allow us to determine a risk number. We want to match your risk profile with the risk profile of your portfolio and make sure that it matches correctly. So, well, that's all for this month. We certainly hope that you always know that we're a phone call away. Our job is for you to be able to worry less and live more. Let us know what we can do to help you do just that. Thank you.